Hey, welcome to the episode 2 of Advanced Option Selling course. And from here, we are going to start the discussion for how you can make actual money through options, through selling options. Now, before discussing the complex options strategies and the firefighting, it's important for me to create a base for all my viewers with simple but yet very effective strategies. And in this video, we are going to start with Strangle and Iron Condor. And don't worry, I assure you that this isn't gonna be another theoretical course, but there will be an OTT delivery, that is over the top delivery content to you. Since this is an advanced options series, I am assuming that my viewers already know about call option and put options and how they work. So if you're new to this concept, I highly recommend you to go and invest some time learning these concepts. You can refer my video, I put them in the I section. Okay, so let me give you an essence that what Strangle is, right? When you're into options or option selling, every strategy or every step you take should be visualized with something called payoff starter. During this stream, I'll tell you that how we'll make payoff and which website we use. Most of you must already be knowing it. I'm creating this playlist for someone who does not need to watch random videos from YouTube or buy any courses online, and this playlist should suffice actually, right? Now I'll give you a rough idea of what actually is a strangle, right? So let's say this is Nifty. This is where the market is today when you decide to deploy this strategy. Now what you want is at the expiry, the market should remain in this range. Now if you're successful and you decided it correct and market did remain in this huge range, now generally in a strangle the range is good when it compared to straddles or a butterfly. So this area will be your maximum profit, max profit, right? Now I want you to look at this part of the chart. Do you see this is unending? It just goes on. That means that after market reaches or breaks this level, what is also called a break-even level, your loss will just gonna increase as the market moves towards that extreme. Same goes with the other side. So basically, you want your market to be sideways, as simple as that. Now this is simple only in theory, obviously. Actually, you cannot confirm, right? You cannot give 100% probability that market will be sideways. Now again, for those purposes, when you are wrong, we have something called firefighting that we'll discuss in the later part of this playlist. Is a special point I have for you, which I learned in this workshop, that is gonna change your style of your options, that is gonna change your profit and loss, and that is gonna change your confidence, believe me. So stay with me, right? Now guys, a beginner or anyone who does not want to take this risk should always hedge the strategy. So after hedging, let me change the color. After hedging, the chart will become something like this. Sorry for the asymmetry, I'm not a computer, right? And so you see there is a misalignment between these lines, right? That is not by mistake, that is by choice. See, when you buy a hedge, you're basically paying some premium, or you can say you're buying the insurance. So the maximum profit as well as the break even will reduce, but obvious, right? But there is a trade-off which you have to think, that is hedging your strategy against a wider break even and more profit you can achieve. Okay, so I guess till now it's clear that what is a strangle. Even a beginner can now understand that how a strangle works. Now let's quickly jump to this website. Those of you who don't know, you should bookmark this website called Opstra. Just write Opstra and go to the strategy builder section. You can click here and go to the strategy builder section. Here we'll try to make or imitate the strategy which we are talking about right now, that is Strangle or the Iron Condor. So first of all, this is the select index. We are working with Nifty. Select segment, we are working with options, right? Now something called expiry. So since today is 26th of March, we'll go for the April expiry. So select the last date for April. Right. Now how to select option strike price. We already talked about Wix divided by under root 12 formula. So you can do that, right? We'll go to trading view to see where Nifty is and what is the value of Wix. You can see Nifty current price is 17,153, whereas the index Wix is 23, trading around 23. So that when you calculate it will come out to be 6%. Right? We'll select a ruler here and try to see where is 6% coming. Right, so it is coming somewhere around here in the top side. You can make a horizontal right line here so that you can track it. What you can do is just click Alt plus H. There will be a horizontal line created. And similarly, let's bring back the ruler and check for 6% again, right? Now, yeah, right here. Okay, Alt H. Here it is. So this will be your range. And if you see, many people don't go with this formula of Wix divided by under root 12. They just try to see the support and resistance. See, and this is the vertical line. We can create it by Alt V. This is the date of expiry, 28th of April. So till this time, you want your market to be here.
Anything, anywhere. Like by kahin bhi trade kar lo. Trade anywhere, but please before this red line, please stop between these two lines. You stop here, I don't care. You stop here, I don't care. You stop in between, I don't care. But you want your market to stop between these two lines. As simple as that.
Now let us see in Opstra how much money has to be deployed and what is the return you can guarantee. If the market closes between these range. That is a huge range, right? 70,100 trading, 80,138. That is approximately 1,000 points. We can't keep on moving violently like these, right? There was an event of Ukraine-Russia war, and that was a result of an extreme war. If you still see, we are still with the range, So that's how much cushion, that's how safe and what cushion can Strangle provide you. I'm not saying that it is risk free, it is loss free, but yeah, it gives a good range to play within. Okay. Okay, now let's go to the Opstra. So our levels have been decided, 80,100, and at the downside, let's keep it 16,100. Yeah, 80,100, 16,100, as simple as that. 18,100, a call option, we need to sell it, right? We'll just work with one lot. So this is about simple call option, right? It's basics. Let's sell the other leg for the Strangle. I'm sorry, 16,100. The put option will sell it for the same expiry, one lot, yeah, at the position. Ta-da! So this is your Strangle, which you can track every day or after every interval till the expiry. You can just save the strategy, go to the portfolio, you'll have the real-time profit and loss. You can do adjustments, you can change the payoff, update the payoff, it is all yours. Just telling you, in case you decide to deploy such strategies, you should know how actual traders are doing it. I'm not an excellent trader, but yeah, I can teach you or I can tell you what is happening in the option selling world. Yeah, fine. So if you see what it's selling, probability of profit, it's 70%. Now just ignore this part why it's selling 70%, because you have a wide range. So yeah, just ignore this part for now. For maximum profit, you see that is 13,200. Maximum loss is undefined because you don't have a hedge. Break-evens, this is the important part. The break-even is 15,836, the down part, and up part it is 18,364. This one and this one. And the estimated margin premium, there is 95,000. Let's give it 1 lakh, right? Maximum. So 13,222, 1 lakh, easy calculation, 13%, 13.2%, right? So now that is a humongous returns for me at least. So now many people can think, hey, that is 13% in 1 month. I can sacrifice few returns, few points for a hedge because I don't want my money to vanish. So what we'll do, we'll create a iron condor on this strategy. So what you need is to buy a put option here and a call option this side, so that this part flattens and your loss becomes limited. Now how to decide what should be strike price of buying that option? Generally people buy the options at these break-evens. So for us it will be 15,800 and 18,000, let's say 15,800. A put option you need to buy and 18,400 buy and 18,400. Now you can also modify strategies by your own views. Now let's say you're afraid that market might collapse or give a good correction in upcoming days, but you are not worried about the up move. Maybe you have a good portfolio, you're already long in other positions, whatever may be the reason. So you can just buy the put option safety and leave the call option safety. But yeah, let's buy the call option for 18,400 to make it super safe. Now you see, maximum profit is 4,500 and maximum loss is 10,600. Now many of you might argue or become doubtful that, hey, maximum loss is almost double, more than double than the maximum profit that I am gonna make. But see, your chance of winning is more because you have a good range to play with. So first point is your range. Already you have a good probability of winning. Secondly, even if you want to, we'll be covering these topics of firefighting in upcoming videos, but let's give you a glimpse of one such strategy. Now let's say the market comes to your break-even point, right? and it breaches it. What you can do is sell call option. Sell call option from here. Oops. Yeah. Sell call option in this range. Yeah, perfect. So let's say market is moving towards the downside. What you can do is collect some premium by selling call option. So your loss will come down and down. What I mean to say is, let's say it comes to here, we're gonna sell 18,200. 18,200 ka call option. You can just sell it for the same expiry, man. You see, the maximum loss now becomes 5,000 in the downside, right? Now, obviously, you're keeping open the upside loss potential, but at the end of the day, you need to be practical in the market. Market cannot just move down 7% and again 8-9% towards the upside, right? And that too during the same month. So yeah, that's how you need to play with strangles or the iron condor. Let me share with you some very, very important points when it comes to strangles. There you go. Now time for few points you need to note, which I myself have experienced during my trading journey, as well as I've learned in very expensive courses. First, if you're new to option selling, your bet would be strangle. That too with a hedge, that is go with an iron condor. So those who are thinking to start their options journey or the option selling journey, start with an iron condor. Sell it. It requires less medium because it has a hedge and you already know the fixed loss that can happen. Second point, you can make some good and consistent profits in the weekly options by selling a strangle. So basically you can sell strangle on Tuesday for a weekly expiry on Thursday and you have theta decay in your favor. But beware gamma effect, that is if market goes to an extreme end at any side, that can give you huge loss. So in that case, either you need to do the iron condor, that is with a hedge, or you need to learn the firefighting. But let me tell you, it can only help to up to some extent. Third key point, hey Karthikeyan, how to select the strike price. Now one way is you can find the resistance and support through the charts, or what I have been taught is use the formula VIX by under root of 12, let's say for the monthly. For quarterly it will become VIX divided by under root of 4 because there are 4 quarters in a year. There were 12 months in a year, so divide by 12 for monthly options. Now the secret to strangles and straddles that is not commonly known among traders and is taught in extremely expensive courses and workshop. Be with me for the next episode.